Okay, so we had an earlier meeting. Keyword is inflation. Now, this week's work, so the keyword is inflation. We had an earlier meeting. People haven't been coming. That's fine. I understand. That's why we do the recordings. Not even close to being a problem. But the only issue is what we want to cover here. So in chapter 5, in week 5, actually, and we're coming down to the final weeks. I can't believe how quickly this has gone. Again, inflation, keyword. This is the guidance, right? I'll get back to that in a minute. But the question is going to be, what are we trying to learn in module 5? Well, the overview is going to be what is money, right? Money, and how does the Fed influence foreign exchange? Okay, so one of the main questions in terms of how the Fed maintains foreign exchange is interest rates. The Fed moves interest rates around through activities such as the buying and selling of treasuries in the open market. So when they want to raise rates, and we talk about aggregate demand and aggregate supply, when too much money, and they really are, it's a function of the Fed trying to control the money supply. When too much money is chasing too few goods, and too much money is chasing too few goods, you get inflation. Think about it. More people have money, less goods are being produced, and prices are going to go up. And when not enough money is chasing the goods, you get a recession. And that's what the Fed deals with. And today they were supposed to be dealing with interest rates. I'm not sure when that's coming out. I think it might be 2 o'clock. So you should definitely follow that. Okay. Okay. You should definitely follow that. All right. So, so the point is, what does the Fed do? Well, when we're in inflationary times, they want to raise interest rates. And the reason why they want to raise interest rates is they want to dampen the demand. Because if rates are higher, then people leave their money in the bank and they won't buy stocks and they won't start businesses and they won't buy goods as much because they want to earn interest. They got the incentive to earn interest. And when rates are low, people can't leave money in the bank because they're not making anything. So then they buy stocks and they start businesses. And I'm going to show you a video now. I have a couple of very helpful videos that will kind of explain how this works. All right. How does the Fed actually move interest rates around? And remember, if I'm looking at two different currencies, okay, if I'm looking at two different currencies, the USA versus Europe, and I'm trying to determine where I want to keep my money, well, the payment for keeping your money in a currency is going to be interest. If interest rates are higher in one country, you're going to be getting paid more and you'll get more of that currency if the currency stays at the same level. So that sounds like really kind of simple, but you got to remember inflation, and that's why I made it a key word. Inflation, inflation is really basically telling us that my money buys less. Prices have gone up, but I'm not getting anything more. So for instance, if I'm getting 5% in the US dollar and I'm also getting the same 5% in the euro, well, then one could argue if everything is equal, everything being equal, that one can argue that, hey, I'm getting the same money in either case. I'm getting the same money in either case. But if inflation's higher in the US, you're actually getting a little less. So if inflation is running 3% in the US, your real gain is going to be 2%, 5 minus 3. Because you're only just paying 3% more for goods. But if inflation is running at 2% in euro, you actually get an extra point. So you want to factor that in. Another thing we want to address is the purchasing power parity and the balance of payments, which means that when our currencies are strong and other countries try to keep our currency strong, so it benefits them. So if our dollar buys more yen or more euro or more pound sterling and stays strong, we're going to buy more goods overseas. And a lot of those countries rely on us to sell them to buy those goods from them. But in this case, we're giving them our cash and they're giving us the goods. So it's a negative to GDP because we're actually having other people do our work, which is fine because free trade doesn't hurt us. Free trade actually works for us because more is available and we get it more efficiently. But we want to get better deals, and that's kind of the political argument. We want better deals. We're not necessarily against trade, but we do want better deals for our country. It's just not being political. That's just the way it's always going to work. But in other countries, they're selling us their goods and taking in our cash, and that's positive for their GDP. So in fact, if you think about it, we almost have a situation where we've taken some of these countries and they become manufacturing zones for us. Because in effect, what are they going to do with all this cash? If we're giving China or Germany our cash, they're going to have to come back and invest it in our currency. All right, so let's watch this. This you're going to find very interesting, and this is what we're talking about. So a couple of key points there. Balance of payments. We buy more goods there, then effectively we are effectively, if we buy more goods in another country, we're effectively giving them our cash and taking in their goods, right? Okay. So we buy more goods in another country. So it's a negative for our GDP. But if you look at it in the abstract, we're using those countries to produce goods for us at a better price. The other thing would be when they sell us goods, it's positive for their GDP. And then they repatriate their dollars back here. So it lowers our interest rates effectively. So this is not the world's worst thing, but we want better deals. In fact, that's what the government usually argue about. Okay. So let's take a look at this video together. I just want to make sure. So annoying. You got to make this one thing with this system. I want to make sure I'm sharing, not just sharing, but I'm also sharing the sound. And not easy. This is not an easy system, Microsoft Teams. For as good as it's supposed to be, it can really be challenging. Okay, let's see if that works. All right, inflation being the keyword. Watch how the Fed controls interest rates. Okay, so welcome again. This is for my macroeconomic classes, and I'll put it in my economics. Basically, I'll stick it in my economics module or my YouTube playlist. But it's the workings of the Federal Reserve, and we know that the Federal Reserve is in charge of monetary policy. So by what they basically do, and it's the most effective way of modulating the economy, and we've talked about it in other texts, in other videos, is that we're looking at if we're in an inflationary time, if GDP is growing too fast, then the Federal Reserve wants to raise interest rates and will slow the economy down. And think about how that works. When the Fed raises interest rates, they effectively make you want to keep your money in the bank as opposed to investing in businesses or the stock market, right? It's logical. Interest rates are higher. People are going to want to borrow less money to buy cars and houses. They may buy a house and a car, but they'll buy less house and a car. So the economy doesn't grow as quickly. So the monetary policy, and then when the economy's in a recession, like we went through after 2008, well, now we've seen that the Fed tries to keep rates lower, so they encourage people to invest and start new businesses and things like that, because that's what gets the economy going. That's how we pay taxes. That's how people get jobs. And the best way to get an economy going using Keynesian economics, John Maynard Keynes, is to lower interest rates. So the Federal Reserve is at the top of this pyramid, and they have the Board of Governors, which is the governors of each region, and we talked about that in previous videos. And then you have the Reserve Banks. So the governors and the Reserve Banks kind of go together, and they watch the different regions in the economy. But what I want to talk about today, and you can get that in previous videos, but what I want to talk about today is the Open Market Committee, because it's the Open Market Committee that's basically the trading desk of the Fed. So when the Fed gives the Open Market Committee an order, they will conduct the nation's monetary policy. And what does that mean? What does it mean that they trade? How does the Fed trade? Well, when the government needs to buy bonds, when the government needs to borrow money, right? If they spend more than they're taking in taxes, they need to borrow money. And the way the government does that is through the Fed, which is the central bank. They will sell, they will, to control a recession, what they'll do is they will buy back bonds. Well, let's start with the inflation. The economy is growing too quick, and the Fed wants to slow it down. Well, effectively, what the Fed does when they need to borrow money is they sell bonds. Effectively, what they do is they borrow money from people by issuing bonds, which are basically tradable loans. No different than any other loan. It's a tradable loan. It's a treasury bill, a treasury bond. Depending on the length, it's either a bond or a bill. If it's 5, 10, 30 years, it'll be a bond. If it's less, it'll be a bill. But in order to control, so what the Fed will do is that the Open Market Committee is when they want to borrow money, they will sell these bonds to the public, and the public
will give them the cash, and in effect, they're borrowing money from they're borrowing money from the people or from the banks. And, when they borrow money from banks or they borrow money from insurance companies, whoever buys them, it's basically our money backing that. Because think about it, where does an insurance company get their money? They get it from the premiums we pay, right? And then they invest them, and then they pay out when people have a liability, car accident or life insurance, property damage. But they invest that money. So it's basically our money they're investing. Or if you put your money in a 401k or buy a mutual fund or get it swept in a bank account, the institutions, the intermediaries are investing, but effectively they're investing our money. That's where they're getting most of the money. Some of it is corporations, but a lot of it is personal money. So now you get the idea. When the Fed wants to borrow money, they'll sell the bonds and take cash in, and when they and that also acts as a way to control inflation. And how does that work? Well, look at this. The Fed will sell bonds to these banks or intermediaries or individuals, the interest rates will go up because in order for people to want to buy these bonds, the Fed has to offer higher and higher interest rates. It's a classic supply demand problem. The higher the interest rate, the more you'll want to buy these bonds and keep the money out of the economy and put it in a bank or in the bonds themselves. So, the banks will pay higher interest and the government effectively pays higher interest. And the government is actually the safest investment because the U.S. government is the safest investment on earth, given our military power and our infrastructure. But also banks are very safe, and a lot of AAA companies like Coca-Cola and IBM are very safe. So our interest rates go higher, but so the bonds get sold to these banks, interest rates go up, and then what happens is when the interest rates go up, it slows the economy down. So it's not just a way for the government to borrow money, but through open market operations, it would be a way to slow the economy down and control inflationary pressures. So again, when they want to control inflationary pressures, they sell these bonds to the banks, and in turn, the individuals or the companies or the insurance companies will buy these bonds, and they will raise interest rates because the more bonds that the government wants to sell, the higher the interest rate has to go. So that kind of gives you an idea of how the open market committee acts. So when the Fed actually wants to slow the economy down, they will sell more bonds to the public and take cash out of the economy. And on the other side, when we have a recession like we experienced after 2008, and the government actually wants to lower interest rates to get the economy moving, well, then what they'll do is they'll buy these bonds
That was a
back
right message.
from the public. And when they buy these bonds back, and I'll get into the math in another video, and we'll do present value assumptions. But going through some of my other bond videos, we know that if the government wants to buy back these bonds, they have to offer better and better prices to the traders or to the banks. If you bought the bond at $100 or $1,000 per bond, and the government turns around and says we'll pay you $1,100, there's an encouragement for you to make a profit and sell it back to them. But the higher price means that the interest rate is lower. And you remember that from our present value calculations. Interest rates are lower because now the government is buying back these bonds. And so they're lowering interest rates, they're raising the prices of bonds. So the bonds go back into the central bank, and cash goes into the economy, and now more cash is available. So the
Hello?
banks, in order to get rid of that cash or to make a spread on that cash, because how does a bank make money? They take your deposit and they lend out the money through mortgages, car loans, business loans. They have to lower interest rates, and the lower interest rates spurs the economy, encourages investments in stocks through margin loans, in companies, because people don't want to leave their money in the bank, so they start a company or they invest in companies. So you start to see the basics behind central bank and open market operations. So once again, to recap, when the Federal Reserve through the Open Market Committee wants to slow the economy down because they're worried about inflation and that the economy is growing too fast, they will sell bonds or effectively borrow money and take cash out of the market. And given the inverse relationship, when the more bonds they want to sell, the higher interest rates they have to offer the public or the investors, and that will raise interest
Oh, her
rates and
too. She
slow
left.
the economy down. High interest rates. When they want to get the economy going, like we're experiencing now, they will buy bonds back at higher prices, and the higher prices imply lower interest rates. And low interest rate. And the basic thing you want to take away from this, even if you don't want to be a economic genius, what you want to know is that when rates are low, people will invest in stocks,
What are you gonna get, a
companies,
light color?
buy more house, buy more car,
You gonna get-
buy more things on credit because rates are low. And when they want to slow the economy down, they will borrow money, crowd out the normal investor by borrowing money and raising interest rates. And what they'll do effectively is slow the economy down.
No,
So that's
No,
basics.
seriously.
We'll have more videos. Go to my economics and my finance channel, and a lot of this will be here. But that's the basics, and we'll talk more. Thank you.
okay, so that's one
This
video I
is
want to show
essentially how
you.
bonds are valued.
Now I want to show you another video that'll explain purchasing power parity. Because even though we discussed currencies, we want to see how it relates to purchasing power. Really important, very important stuff. So this will kind of like wrap it up, okay? Only because I did this twice today. So let's take a look at this. Okay, so this is a video that I'm preparing for my economics classes, or international business classes about in purchasing power parity. And what is that? I mean, what does that mean? Well, really it comes down to, why would I buy one currency over another? For instance, why would I want to put my money in the euro versus the US dollar? Well, the first question might be interest rates, right? Interest rates might be, on an inflation adjusted basis, more attractive in one domain than another. For instance, the US is now paying close to 5% in treasuries, and according to the Consumer Price Index, if inflation is running at 3%, you're making a 2% rate of return, right? Think about it. Prices have gone up 3%, you making 5, you're making 2%. You can't just go with raw data, you gotta go with inflation adjusted data. And in the euro, if they're making 5% but inflation is running at 4, you're getting less of a good deal. So that would be one reason. Other reasons might be macroeconomic factors, like you feel long-term growth in one zone versus another. You'd rather own the stocks or the assets in one place or the other. And if you want to own assets or stocks in the European market, well, then you got to get into euros. If you want to do it in the US, you got to get into dollars. Another reason might be political stability. You might feel that one area has better political and economic stability than the other. Economic stability coming from the central bank controlling the value of the dollar or the euro, or political stability, where right now we're witnessing the problems in the Ukraine, even in the Middle East, which affects Europe. And you may not want to be there right now. You may want to be in the US, where political stability might be more secure, right? It's just a kind of a call based on your long-term or short-term outlook if you're an investor, a pension fund, a bank, a sovereign wealth fund. So, given those things, what else do we want to look at? Well, one of the big factors would be purchasing power parity, which they've used the Big Mac Index and some of these other things to try to compare what something buys with a currency. Because when you think about a currency, it's either a unit of account, which means you can measure things with that. For instance, my cable bill might be 1/5 my car bill, right? Or it's a store of value, which allows me to see how much money I've saved or how much I've accumulated. Or the medium of exchange, and that's what we're talking about. When I exchange my currency for something, how much goods does it actually buy? Right? For instance, a dollar is just a piece of paper with the presidents on it, right? God bless them. Or the euro has the same issue. But I'm buying goods. And if I'm buying goods, how do I compare these goods? For instance, if I go to a baseball game in Japan, and I saw a video recently, like they eat all kinds of different stuff, a different culture, right? They eat fish or some bubble shakes or things you wouldn't see normally in a U.S. game. If you go to a U.S. baseball game, you're seeing hot dogs, hamburgers. So even though I have to transfer yen for something, or dollars for something, the game, what I have at the game, the food I get at the game, it's going to be different things. So sometimes I feel that the best way is to find things that are fungible. So for instance, the Big Mac Index has worked for a while because they just price what it costs to buy a Big Mac. We've heard these stories like in Vietnam. If you go travel to Vietnam, you can get a luxury hotel room for $100 a night. Things have different purchasing power. I like to look at the Four Seasons because this is a luxury hotel brand. It's well known. It has amenities that are pretty much the same anywhere you go because that's what they're selling. Top amenities, top service, good bedding, beautiful rooms. Now, if you stay at the Four Seasons in New York, you're going to pay about $2,000 a night, which is a lot of money.
no question about it, for a regular room. And if you buy a room in Montreal, for instance, it's more like $500-600 a night. That's a big difference. Now, one could argue New York is different than Montreal. New York is obviously one of the biggest, if not the biggest city in the world. It has a lot of things to offer in terms of doing business there, if you're doing business, or the theater, or museums, any of the stuff that makes New York special, right? But then again, Montreal's not a horrible place. It's a beautiful city. It's got that Parisian feel. It's got the same good food. It has the arts. It has beautiful churches and museums. So if I adjust for that, and none of this is ever easy, even a Big Mac is not easy, not on its face. If I adjust for all of that, there's some places they may not even want the Big Mac, right? But if I adjust for all of that, is the Four Seasons room in New York worth 3 times what I'm going to pay in Montreal? And that's purchasing power parity. For that same experience, if I don't step out of the hotel and just stay there for 3 days and do business, is it the same? With the same people? And that's when you start to talk about purchasing power parity. So I want you to think about that. That's why I'm introducing this as a concept. When we're dealing with currencies, or we're saying, "Oh, that's a good deal," or "I should go and travel here because I do better with my dollar," and I'm obviously translating it to another currency. Are you getting the same experience in every place? And if you could say yes to that, then you've answered the inflation question, you can answer the macro question, you can answer the political and monetary stability questions, and you can answer what my dollar is actually buying, or what my currency is actually buying. So why don't we start that with food for thought, and I'll follow up with some other videos.
Okay, so that's basically it. Oh, come on. So now the guidance, give me a minute. It's so annoying. Oh God. The guidance is going to be right here. So when you're looking for guidance for this week, you have to put together this PowerPoint. So I just want you to really follow this. You could come up with your own stuff. But now that I taught you what this is about, and again, it was a longer class earlier, but I just had to the recording just didn't work. There are your different panels. Okay, role of the Federal Reserve, central banks in other countries, commercial and private banks, all things the Fed, balance of payments we spoke about, exchange rate risk management. We can hedge off the risks. We can hedge off the currency risks. We can actually produce in other countries and have most of our expenses there. So as we say, for instance, if BMW made the BMWs here in the U.S., most of their cost structure could be paid for in dollars because you're hiring U.S. workers, you're paying U.S. rent, paying U.S. electricity, and then you just have the profit to go overseas. So that's a natural hedge. Or you could use a forward, which is a negotiated contract with a big bank. Or you can use a future, which you go right to the markets to hedge off your currency risk. Or you could use options that have limited time, but also limit your risk. But you have limited time, like an auto insurance. You pay, say, $600 every 6 months. You're insured for 6 months, but when that 6 month comes out, you got to buy it again, or you're not insured. And finally, your market recommendations and any summaries, and I give you some additions in terms of how to do this. Now, some more guidance. I give you total guidance. Now, if you want to add a speaker note, go to insert. Okay. Hopefully I am sharing this. Oh, God, I got to tell you. If you want to add a speaker note, you got to give me a minute. I want you to speak. Yeah, okay. If you want to add a speaker note, you just go to audio and add. Then just record. This would be a speaker note, and this is how you do that. And then you just put it in. Right? It'll come up on that page right here, that little thing. Okay, so even though I did it a second time, inflation's a key word. And if you didn't like your speaker note, you could just click on it and cut it, get rid of it, and you can delete it. Just be aware of that. So you're going to go here and cut it. All right, so that's it. Use inflation as a keyword. Use my guidance. remember those 2 videos because that'll tell you a lot about what we're doing here. And stop sharing for a minute. Give me 1 second. That's it. Thank you. And and contact you with any information you need.